Hey everyone, welcome to our July 2021 real estate market update. We are so glad you were able to join us live today and be the first to receive this pertinent market information. I just realized I've got ahead of myself and I'm a slide too early, so let me back up. Before we jump in, I want to cover our disclaimer with you. This presentation is for general information only. Any of the information that we share with you today is designed to help you assess the market, but prior to moving forward with any investment deal, you must conduct your own due diligence. When joining this call, you acknowledge that Catalyst Funding and its agents are not liable for any loss or damage caused by your use of the information presented today. Again, we really want to provide you this and help you, guide through the market. And if you have a specific deal that you're working on that you want to touch base with somebody outside of your circle, we have trusted advisors here in-house that are fully licensed loan officers, and we're happy to set up a call to discuss your specific needs. But in general, take this information and continue your own research going forward, or give us a call and we're happy to walk you through it. So without further ado, I'll go ahead and introduce our speakers today. If you've joined us before, we're welcoming back our founder and CEO, Wade Comeaux. Without Wade, we wouldn't have a company and thus no webinar. Wade is a licensed real estate agent and an active investor himself. He is passionate about helping all of our clients achieve financial freedom through investment, which is one of the many reasons we put these webinars together each month. So thank you, Wade, for joining us today. We're so excited to cover all of this. Austin is our sales team manager and he is a fresh face on the call. This is his first market update webinar with us, but you probably met him at some networking events, or you may have even spoken to him in the past if you worked with Catalyst. He did start out as a loan officer a few years ago, and he has worked his way up while continuing to invest himself, and so he is also an active investor. So these two have a lot of information on what's happening now. They are relevant with it, not only for the company, but for themselves as investors. So we've got some really good speakers and some really great information to cover today. I'll go ahead and pass it over to Mr. Poole. Austin, if you would like to jump on and maybe introduce yourself again.
Definitely, appreciate it, Destiny. Definitely happy to be part of the webinar finally. And before we get into the market update, we did want to cover what we provide as a company. So we are a full service lender, which means we provide the short-term financing and the long-term financing for all of your single family real estate investment needs. We are a lending company built by investors for investors. So our team has been involved in literally thousands of transactions. So we started the lending company back in 2014. So we've been doing this for quite some time. We do have a single point of contact model, which does differentiate us from other competitors. Traditionally, you would have to get a hard money lender to purchase the distressed real estate, and then you would have to go find a conventional or non-conventional lender to refinance you. We do all of that in-house, and you're working with the same person throughout the entire process, which makes it a lot easier for yourself just to be able to navigate through the real estate investment process. We do have 5-star reviews across the board. We have hundreds of 5-star reviews throughout Facebook, Google. If you're a member of any real estate organization, we probably have reviews there as well, all 5 stars. So the loan products that we have to offer is going to be hard money loans. So that's going to be the money to purchase distressed real estate for people who are just getting into it. So that's the money to just buy the property and to fix it up. And at that point, you can either sell it, which would be considered a flip, or you can refinance out into either a conventional loan or a non-conventional loan. So if you don't qualify for conventional financing, we do have 30-year fixed no income doc loans for individuals who may be self-employed and write a lot off on your taxes. But we also offer loans for your primary home. So if you're looking to purchase a property, to refinance your primary, or pull cash out, that's something that a lot of investors do to be able to utilize the money in their own house, especially because prices have been rising. You can pull cash out and then fuel your investment career from there. As far as our hard money loans, our rates do start at 6.99% and 2 points, which is the best in the industry. And we do have a VIP flip program for those of you who don't know. And to jump back, the hard money starting at 6.99 is going to be if you're wanting to buy and hold a property. So if it's going to be a rental, that's where the hard money rates would start on that end. As far as our flip program, the rates are as low as 9.99% with only one origination point. We do have best-in-class pricing on the non-QM side. So our 30-year fixed non-conventional loans, we have if you're looking to refinance a single property, we can do that, but we also have a blanket loan program, and that starts at 3.875% on a 30-year fixed. And with the blanket loan program, you do have to have at least 5 properties to put into the blanket loan. But it will allow you to free up your conventional slots so that way you can continually maximize your conventional loans if you utilize that and qualify for that as well. Another thing that I do want to mention is that we work closely with many wholesalers around Houston, San Antonio, and Dallas, and we help place off-market properties to our pre-approved buyers. So if you're a wholesaler or if you're just looking to find more deals, definitely get approved with us so that way you can get on that list and see the deals that we have to offer. And one thing that we'll touch later on in the presentation is that we do have a new product that we're rolling out. It is a Airbnb product for investors who are looking to purchase properties and hold them as Airbnb, so there's no DSCR requirement, which is really exciting. So stay tuned for that.
Awesome. Thank you, Austin. I gave spirit fingers for that new product. It's so exciting. We just keep rolling out new products around here.
Absolutely. Exciting stuff. So today we're going to talk about 3 overriding themes, in my opinion, and we'll go into this slide in a second. But on a high level, what we're seeing is that while the real estate market is still very hot nationally, it is starting to slow down a little bit, which is something we've been talking about for a while. Slowdown does not necessarily mean that prices are decreasing. It does mean that the enormous amount of appreciation, kind of unprecedented across the country that we've seen recently, is starting to slow down. But then another interesting thing is that it is not slowing down that much in Texas. Although we do anticipate it happening eventually, we're not seeing as much of that slowdown in Texas. In fact, there are records being broken all across the state. And the last thing I would say is that we do anticipate interest rates starting to increase over time. There's a lot of forecasters that are saying that. So we do believe it's still an ideal time for you to invest, and that you do not have to wait on any perceived, some people out there are saying there may be some crash that is imminent, and while we don't have a crystal ball, the data does not really seem to show that. And then Austin and I were at one convention, and then Jeff and I, whom you guys know, were at a different convention where some of the smartest real estate people in the country were in attendance. And what we're saying is really the consensus that we heard at both of those industry events. One of the biggest reasons why is this chart. And we've shown it for the last few months, but it tells a very important story in that over the past decade, after the mortgage crisis back in 2007, 8, 9, there have been fewer homes built in this last decade than all of these previous decades, 60s, 70s, 80s, 90s, and the population has grown significantly across the United States. So there's fewer homes, greater population, and that is what, along with a few other things, is leading to this massive appreciation. And it's the oldest, economic principle, supply and demand. There are just not as many homes out there, and there are lots of people who want to move out of the cities, out of apartment complexes, have more property to do the things that they want to do at their own home. Coronavirus kind of put that in a spotlight that people want to have their own amenities, want to have flexibility. They need extra space because they may be working from home some or part of the time. And that is really driving all what we're seeing today with these massive price increases. On the next slide, just wanted to talk a little bit about another trend that we're seeing that everyone has to be aware of. There is a lot of institutional investors moving into the market. And we talked a little bit about this on the last webinar, but you do have to be aware of how to compete with them. And despite this move, it's been happening for a few years. It's a greater intensity than we've seen lately. But still, the majority of the investors, in fact, 88%, are probably like the majority of the people on this webinar, right? There's a huge value for small individual investors buying properties, and that's why 88% of the single family properties that are owned and rented out there are in that particular class. We are seeing the institutional investors move in, but I do believe that the small individual investors have that market understanding, and it's just hard for a big national company to have, and that's where you can have advantages by networking with people, meeting people who can help you buy properties, working with local lenders that have expertise, working with local contractors that have expertise. You have an advantage over those institutional investors, but we do want to shine a spotlight on the fact that they are a big competitor in the market today. Next slide, please.
So this next slide we're going to be talking about is the housing market predictions for 2022. So as the year continually rolls on into 2022, the cost of construction will come down a bit. So the higher cost of production for homes played a big part in low inventory that we've seen. There is a short-term inflation problem affecting the manufacturing industry, and this has drove up prices for building materials for homes, which we've all seen, especially if you invest in real estate or if you're a builder. But not only that, even for cars as well. Even the car market is crazy because of the inflation problems with the manufacturing industry. Lumber prices alone, it's not on the slide, but I did read on the same article that lumber prices alone added about $36,000 to new home prices. So that is a dramatic increase. Now the buyers chased out of the market by the high prices, and y'all seen this whenever you were looking to buy real estate this past year. You may have put in an offer of 10 grand, 20 grand above ask, and you still lost out. So these bidding wars, all of these investors that have been dealing with this are really looking forward to 2022 and the end of this year as well, to really jump in strong into the real estate market. So bottlenecks in the supply chain are expected to be fixed with the economic growth, and many companies will not have the supply chain shortages that we've previously seen. So all of that is being addressed, and there's going to be more, there's not going to be as many shortages as the economy continues to boom. So this is going to be play a big part in more opportunities being available for investors. As far as the economic growth started in the third quarter of 2020, it is expected to continue into 2022. The Federal Reserve's forecast is for real economic growth is at 3.3%. Now jumping into mortgage rates. So some exciting news. The one thing that I do want to start out with is that this month, the FHFA announced that they are removing the adverse refinance fee that went into place last year. So if you are looking to refinance, now is a great time. If you were looking at rates, a few months ago, it's most likely that the rates are going to be more advantageous and lower price now. So if you were on the verge of refinancing, maybe doing a cash out refinance, it is the best time to do it right now as we speak. According to Freddie Mac, the 30-year mortgage rate will average 3.4% in the fourth quarter of this year and increase to 3.8% by the fourth quarter of next year. So that is their projections. And they're also predicting that the home prices will rise 6.6% in 2021 and slow down to 4.4% in 2022. And as far as the home sales, we're expecting the existing home sales to reach 7.1 million, and that will decline to 6.7 million in 2022.
Yeah, and I'll add a little bit to that, if we don't mind going back to the previous slide real quick. As far as the home price appreciation, we're going to cover some other projections. There are a lot of different economists and prognosticators, and that is one of the lower estimates that we have seen as far as the 6.6% for 2021 and 4.4% in 2022. So we're going to cover some other data as well, but we wanted to give you guys a well-rounded viewpoint of the future. But what's interesting is none of them really show that the prices are going to be coming down, even the most conservative estimates. Not that that couldn't happen, but we do sometimes hear investors say, I want to wait until the market slows down. And if you think about it, there's really, if the market goes from 12% appreciation to 6%, you're still going to be paying 6% more next year. So unless the properties really start to drop in price, which is really not being predicted at the moment with the shortage of supply, it's a little bit hard to see a significant drop. You may just be taking one extra year, increasing your purchase price, and not having that mortgage paid down an extra year, which really helps you get to the point when you make, truly life-changing cash flow whenever you don't have a mortgage to pay anymore. Anyway, that's what I wanted to cover on that page. We can now go to the next slide. This is also from that same article. A lot of really intelligent people quoted there. Zillow's market forecast said that U.S. house prices will have risen 11.8% by April 22. So you can see that's a little bit higher estimate. They also produced that annual home value growth will rise to 13.5% by mid-2021, and that home values by the end of 2021 will increase by 10.5% from their current level. So that's a higher estimate than Fannie Mae. They do continue to anticipate a boom in home building, right? NAHB's Builder Sentiment, and we're going to cover an actual slide on this in a moment, but their confidence level at 83% is a very, very high number. That means that the industry of home builders believes that there's going to be significant demand in the future. Home builders have to look many years into the future, because if you think about what they do, they purchase property, they develop it, they build streets and infrastructure, then they start to build homes. There's a long tail on this. So they're not looking like maybe many of the flippers or buy and hold investors on the phone, especially flippers, where you're wanting to guess what the market's going to do in maybe 3, 4, 6 months, depending on the size of the project. They have to look years in advance. They're still highly optimistic, pulling a tremendous amount of permits, especially in the state of Texas. So there's a lot of confidence in that space. Another important trend is that we're seeing, and that we're going to continue to see, is moving away from the major cities and moving into smaller cities with more affordable housing, which we're going to cover the affordability index again at the end of this. But another thing is just moving towards the suburbs. That's another common thing that we're seeing with more space. But it did mention Austin specifically. Austin has been very, very hot, the hottest, arguably the hottest city in the country, definitely the hottest in Texas. And I do think that that particular city has the most downside potential, because the other areas, while they have grown a lot, have not been just these massive increases, which there's a little bit more instability whenever you see the massive increases, like we'll show in a moment. I think maybe 44% year over year, something crazy like that. So that is a little bit of a unique circumstance. And then other cities like San Francisco and other cities on the coast, there's a little bit more of an anticipation of moving away from those markets. Next slide, please.
Yeah, and before I jump into this, I do just want to point out, we work with a ton of people who are actually investing out of state. So we have buyers all over the United States that are investing here in Houston, San Antonio, Dallas. And so if you are out of state and you're looking to invest, obviously Texas is one of the best places to invest, and that's why these big institutional investors have been coming here as well. So we're right on the cusp where you can still get in and investing in real estate at this time. I can't preach it enough that at this time is the best time. Now on this slide, we did put a couple quotes in here from the senior economist and director of forecasting of the National Association of Realtors. So I just wanted to read this and share with y'all the thoughts that are coming from these people. So Nadia said, I expect the housing market to remain strong in 2022. While typically a hot market is indicated by rising prices and strong demand, I expect home prices to continue to rise. We may see a slower growth compared to this year, as more inventory will come to the market with fewer COVID-19 restrictions later this year. But with low mortgage rates, rising employment, and growing millennial demand, this will keep the housing market strong. And I thought this was very interesting. She mentioned, keep in mind that about 4.6 million millennials will reach the age that millennials typically get married in 2022. So there is going to be a lot of people looking to buy houses and getting into their first homes. And she did mention that she expects home prices to rise 9% and 3% in 2021 and 22 respectively. Now, another chief economist from the National Association of Home Builders Robert mentioned that the new construction market continues to be hot and with demand outpacing supply. And we're going to get into this on the next slide as well. But he mentioned, however, all costs and types of construction materials are rising, which is forcing new home prices higher. In fact, in April, new home prices were up 20% year over year. And these price gains reflecting higher costs of construction are unsustainable and will inevitably price some prospective home buyers out of the market. And this is something that, you know, home builders have been struggling with. I have quite a few friends that are new home builders, and just the prices of material have continually caused them to raise their prices, and they're seeing fewer people coming in and buying the houses because it's starting to knock people out of the market because it's getting so high. And we're going to cover the projections on the next slide. But just the last sentence that he had here was, consequently, we will see some cooling of these growth rates in the months ahead.
Yes, that cooling is the common thread. But there's another great quote here from Peter Cardillo, chief market economist at Spartan Capital Securities, which says, have we reached a peak? That's possibility, but worst case scenario, I see a leveling off. And that is the common thread. Like all these people are saying, you know, 14, 15% last year, depending on where you were. Then, you know, maybe it's 12%, some prognosticators, some 6%, and then maybe a little bit less the following year, but really haven't seen many forecasting a decrease or depreciation anytime soon. So this is a very interesting chart. What this shows is nationally, this is a national chart, not a Texas chart. We're going to get into the Texas information here shortly. But you have the green, the bright green there, which is existing home sales. And you can see there has been a slowdown in the total number of home sales there, that green line. And the opposite thing is happening with the months of supply. So there was a real peak. You can see that early 2021, late 2020, market was super hot, super amounts of home sales across the country in basically every market. And then that gray line is actually covering the months of supply. And most of you probably know, if you've been on the webinars, and if you don't, that 6 months of supply is considered equilibrium, balance between supply and demand. So nationally, the number actually got, you know, like 1.8, which is just incredible, kind of unheard of. You see, never, that gray line has been hovering between 6.5 and 5.5 maybe for a very long time. But it is starting to cool off a bit. That number is now at about 2.5, right? Still, compared to any time 2016 on, and if this chart went further back, that would still be historically outstanding. But we are seeing not quite as hot of a market, especially nationally.
So on this next slide, this is going to get into the U.S. Homebuilder Sentiment. So this is the basically the feelings that home builders have, whether the market is, you know, if it's going to be strong or not. And the top graph here is going to, you can see that there was a lot of pessimism from home builders whenever COVID first hit in 2020. You can see that large drop on that top graph over there, right, whenever 2020 hit. And that's just due to many uncertainties that we all had, right? And shortly after, it ramped up significantly. And you can see it jumped up even higher than what it was back before 06. So we're still higher than then, and we plan to continually at least level off now. And the higher costs and rising home prices appear to be slowing the traffic of potential home buyers. So that's what we were talking about on the other slides. As the costs continually grow, the potential home buyers are going to decrease because they just start to be priced out of the market. And home builders are at a higher level of optimism even before the recession started. If you look back, you know, to 2006, the inventory drought has provided great support for home building, and but that support appears to be going down slightly. And that takes us to the graph below, where it's covering building permits. So again, this is on a national level. This is not on a Texas level. But if you do look at the bottom graph, it shows the amount of building permits opened. And groundbreaking of new homes actually increased in June by 6.3%. However, a more forward-looking approach brought to us to analyze is how many building permits were opened, and this actually dropped by 5.1% to an 8-month low. So even though the groundbreaking construction this month is still going really strong, the amount of building permits are at a 8-month low. Now later in the presentation, we will look at Texas specifically, and we'll see how Texas compares to the U.S. overall. But I thought that this was really interesting in the fact that you see home prices are at a crazy high. There's a ton of new construction, but as far as the permits that are being pulled, they are at a low.
Yeah, very true. So shifting gears a little bit, we're going to talk about some changes in the market. For a long time at Catalyst, the large majority of our borrowers would do, would be people who are doing buy and hold investments. They would use our hard money to purchase and repair, as Austin talked about earlier. Then they would move into a permanent Fannie Mae, Freddie Mac type product to hold that property long term. Very attractive pricing, a little bit more rigid underwriting guidelines, a little bit more hoops to jump through, but still a great place, arguably the best place to place your properties if you want to get the best possible pricing. But at the beginning of the year, there were some changes. There was a cap for a very long time at 17%. That was reduced to 7% in March, also retroactive to the beginning of the year. So there was a lot of challenges with mortgage lenders, especially groups like us that were kind of experts in this space, and they had a higher percentage as a company of non-owner occupied loans. And then there was another adjustment in June with Fannie down to 3%. So the good news is that private money moved into the market, right? It has been a little bit more complicated. We got some great pricing relief in the past week. So if you got quoted with us in the past, definitely check with us recently with the half-point reduction Austin mentioned earlier, and some internal price improvement that we had as well. Very exciting pricing, again, significantly better than we were even a few weeks ago. But regarding the overall capacity of the market, the private money has really moved into the market. That's where our more attractive non-QM loans, no-doc loans, pricing has greatly improved. They're amazing 30-year fixed products for people that don't even have to provide income docs. We've also seen that blanket loan product that we've been talking about. We've got a tremendous amount of those deals in the pipeline, and excellent pricing. As we mentioned earlier, could get as low as 3.875 depending on the parameters. That's amazing whenever you're thinking that, non-owner occupied Fannie Freddie loans are not significantly better than that, sometimes not better than that at all in certain circumstances depending on your FICO scores. So that's an amazing product. And then this VRBO product that we're talking about, which is also a no doc, no ratio program that does not require DSCR. So that's one big thing to understand. The reason that it's such a big product that we're rolling out now is before on our non-QM loan, you did have to have a certain debt service coverage ratio requirement. That meant that you had to have a lease agreement. You had to have it documented that you're actually going to cash flow on this particular product, because they're not judging your individual ability to pay, because they're not getting your tax returns, right? But they want to make sure the property cash flows. This new product, it does have a lower LTV, has a little bit higher pricing, but it's excellent for the VRBO product because you don't have a ratio even on the property itself or on yourself as an individual. And we've been hearing great news in the market on the VRBO profitability. I was speaking with someone at an event in San Antonio recently where she was saying if she were leasing this particular property, she'd make like the lease amount would be $1,500, but it was near Fiesta, Texas, and her lowest month was like $6,000. And I think she said last couple of months in the summer she was making $7,500 a month, which it almost sounds to think you could go from $1,500 to $6,000 or $7,500 with this VRBO is really amazing, but that is the possibility. So even if you have a higher rate and a little bit lower LTV, it can be an excellent product for this particular space. The home prices are often going to be a little bit more because there does have to be some attraction, right? There has to be either a vacation area or maybe you're close to the medical center here in Houston or some other reason that people would want to travel there. It could be work, could be pleasure. But if you have that combination, you can really make some attractive returns.
Yeah, and just something else that I wanted to touch on that as well. Now that we're getting, farther away from the height of COVID, a lot of people are wanting to, go out, travel more, and that's why this VRBO, vacation rental by owner and these Airbnbs are very attractive. And one of the hard parts of obtaining an Airbnb is just getting financing. And that's been a struggle that for properties that I was looking at Airbnb, as well as friends that I have that are going and looking out and trying to find higher priced homes, where you get these beach houses and they may be $400,000 or $500,000, and all of the non-QM loans that were out there had the DSCR, and now we have that product that doesn't have the DSCR. So I think that particular market is going to continue to grow, and if you are an investor, it may be a strategy that you would want to look into. Also, on this non-QM product for the VRBO that we're talking about, traditionally non-QM loans are going to have a seasoning period, and this particular product does not have a seasoning period. Which why that is important to you is that you can buy a house, fix it up, and immediately refinance it into that loan without having to wait 60, 90, 120 days before refinancing it.
And so some products even required a 6-month seasoning period. So very attractive. So on this next slide, I just want to emphasize again, while many prognosticators are projecting an increase in interest rates are still historically low. And as Austin was mentioning, the timing is great to be in the market, because if you bought properties back in the 80s, 90s, 2000s, early 2010, you're talking significantly greater rates. Look at that peak back in the 80s, above 18%. The fact that we can continue to get people into non-owner occupied properties, somewhere in the 4% range is incredible. Keep in mind, this rate here and all of this chart is not for non-owner occupied loans. They are for owner occupied loans, and that's the part that's available. Normally, non-owner occupied loans have a certain spread above the owner occupied loans. In the past, that might have been 1% or so. It's been a little bit higher since Fannie Freddie did decrease the amount of loans that could be delivered to them in that non-owner occupied space.
So I also do just want to mention that the non-owner occupied space, with a lot more of these private investors coming in and backing these loans due to the restrictions that Fannie and Freddie are putting on their loans, that current rate that's up there in the top right is actually for a non-owner occupied property, believe it or not.
Not bad. That's it. That's even better than I thought. So.
Yeah, so going back to the slides that we covered at the beginning of the presentation, the forecast that Freddie had going into 2022, those rates were for primary homes, which I believe it was 3.8% or so. So right now, for a non-owner occupied investment property, I believe it's supposed to be 3.65%, but that is at par. So that's not even having any points involved. And if you've refinanced over the past couple of years, to be able to lock in an aggressive price, there were no points involved. So this is updated as of today, and it's very exciting, and even more of a time and reason to go ahead and refinance, do a cash out, and take advantage of this while it lasts, because even the projections that Freddie is anticipating to go into next year for primary homes are higher than this. So just want to point that out.
That's a great point. I totally missed that. It was a lot lower than I anticipated. Good catch.
Yeah. So this slide, we want to dive into the Houston market. So the Houston market, as any of you know who live here in Houston or in Texas and are familiar with the market, is absolutely crazy. The single family home sales increased for the 13th consecutive month. And the total property sales rose almost 17%, with over 13,000 units sold, which is the highest volume in history, which is just absolutely crazy. And it's exciting for people that live here in Houston as well, that your home is continually increasing in value. And for investors, whenever we get to the bottom point, the bottom bullet point that I'm really excited about is the cash flow. But single family homes months of inventory is 1.5 months supply, which is down from 3 months year over year, and is also below the national inventory average of 2.5 months. So on a national level, Texas and Houston in particular is still well below the national level, just showing the boom that is here in Houston. On a year-to-date basis, single-family home sales are running 29.5% ahead of 2020's record pace. which is crazy. And a couple other points on this chart over there to the right, the single family median sales price is $314,000, which is a record high as well. And if you look back a year ago in June, we were at $262,000. So that's a 20% increase. And the single family months of inventory, as we mentioned, is cut in half. So that is very crazy. As far as, this is what I'm excited to get into, for single family home rentals, single family home rentals fell 24.1%, with the average rent up 10.6% to a record high of $2,111. So if you're renting here in Houston, the average market rent right now is above $2,100. Now, if you look pre-COVID, and Destiny, if you don't mind scrolling down just a little bit, I want to show what the market rent was in February of 2020, and it's I think it's cutting off.
Look, I can't scroll down. Hey, Austin, I can't scroll down, but I can go ahead and read it for you. So in 2021, in June, the rent was $2,025. In May, it was $1,960. In April, $1,944. And then pre-COVID, the single family home rental was $1,768. So that was February of 2020. So just before COVID hit, and it has just skyrocketed.
Yeah, so $1,768 just before COVID. So if you had a property and you were cash flowing $300 a month at the beginning of last year, you would be almost at $650 a month of cash flow right now. And as the projections show, you know, as the prices continue to increase, we expect rents to also increase. So the projections and the deals that you're looking at right now with a cash flow of $300 a month or $400 a month, I would expect that to slightly rise, maybe steady out, but it's still a tremendous increase. And even month over month, you can see just in May it was 1960, June was 2025, and it's continually rising. So that is very exciting.
And one of the cool things about cash flow is, you know, whenever you look at 1768 versus 2111, that's a big increase, but as a percentage, it's not as great as the cash flow increase, right? And cash flow could potentially be double very easily from where you were before, maybe even greater. Whereas, you know, 1768 is not doubling to go to 2111, right? But that's just a really significant increase. And another important thing to keep in mind is that rents typically lag home price appreciation, right? Because if you think about it, a home price a home that is sold today can go up today based on what the market will do. But leases, many of the leases are in place and they're for 12 months, right? So there's going to be a lot of times they're not always coming due. Sometimes people extend them and they may not increase them as much. And there's just in general always a little bit of a lag there because landlords have to react to other things as well. Their costs may be going up. You may have a slight increase in taxes. So there's always a little bit of a lag. And historically, when home prices increase, the rents often tail behind it just a little bit. So I would actually anticipate that we're going to continue to see even more appreciation in the rents than we will see in the home prices as we go forward to a certain time frame. And then it'll probably balance out a little bit more.
Awesome.
So the next slide here, we have San Antonio. And San Antonio also has, we did not do as in-depth of a breakdown, but I can tell you that the rent increases have also been really strong there when you look historically and pre-COVID. But what we have on the data directly from SABOR, the San Antonio Board of Realtors there, is that you know, a big increase in the average price. It's gone up about 19% year over year. That's a really big increase. The median price up 17%. Price per square foot up 20%, and the days on market down significantly. Days on market right now is about 26 days. A year ago was about 60. And then if you look down at the residential rentals, the same thing. The number of transactions are down. There's just not as much inventory right now, which that's supply and demand curve we talk about. That's why prices are going up. The rent prices are not up as much here in San Antonio, but I will say I do think San Antonio is a really good market because whenever we look at the affordability index a little bit later, San Antonio is one of the most affordable big cities in the country, and that's going to continue to drive rent increases. And just being such close proximity to Austin, where homes are so much more expensive than they are in San Antonio, you're going to have more of these people who can't quite afford to live in Austin, but need to work in that area with all the tech boom that's taking place there. They're going to start to live further and further away. And we're seeing a big boom in these, suburbs around there, Wimberley or Dripping Springs, or even it's going to continue to trickle into San Antonio. So I anticipate these rent numbers to lag behind and probably be comparable to that 20% home price increase that we have seen over the last year.
So this is we're going to cover the Dallas market now. The median price in Dallas rose 19.3% in 1 year to $310,000. And active listings are down 42% from last year as homes are continually flying off the shelf. So that is huge. The demand for houses and people buying properties, investors buying properties is definitely at a high. Closed sales are up 7.1% since last month, and the months of inventory is 1.4 compared to 2.9. That was just in June. So the months of inventory are actually down, and it just goes to show that people are buying properties as quick as they're listed. And also, one thing I do want to mention is that in San Antonio and in Dallas, we are actively hiring loan officers. So if anybody on the call or anybody that is looking for a career change or looking to get into the investing game, one thing that all of our loan officers are trusted advisors throughout the real estate investing process, and not just dealing with the loan itself. So if that's something that you or somebody is interested in, definitely reach out to us, and we would love to chat.
No doubt. So another thing, and we did not bring it up on this particular call, but as far as the deck itself, but last month we were talking about some information where the total number of new home building permits in both the city or greater DFW area and greater Houston area, each of those individually is greater than the entire state of Texas. I'm sorry, the entire state of California, which is kind of an amazing number. California is a huge state, both geographically and population wise, but they are building more homes with permits in DFW than all the state of California and Houston. So that's pretty incredible how many people are moving to the area and how much home demand there is. Moving on from that into Austin, we were blown away. Austin and I were covering Houston, we're covering San Antonio, we're covering Dallas, and it's like, 19% appreciation year over year, 18%. And then you look at Austin and you're like, okay, it's double that, 43% appreciation, which is just amazing. Up to 482 median sales price. The number of closed sales, that is starting to trickle down. There's just not enough inventory there. That number, closed sales, was like a huge number for quite a while, but just not enough homes to sell, right? So it's down. It's only up 8% over last year. Average days on market down tremendously, only 13 days on market. That's an unbelievable number. I think we just saw maybe in Dallas it was 26, so it's literally half that. 2.62 billion in sales volume, up 55%. And then the months of inventory is down to 0.6 months. I think you guys remember earlier we talked about 6 months being equilibrium. National average, I think, was slightly below 2.5, if I remember correctly. The other major metros in Texas, high like 1.7, 1.8, and then you have Austin at 0.6 months of inventory. And it's a very interesting situation. I think that there's no way it can continue to go up 43% in perpetuity. But whenever you compare the 482 price, and we're going to look at the affordability index in a moment, and I think the average price in San Francisco is 1.2 million. So how much room does it have to grow? If you can get a comparable job, making a comparable amount of money in the tech industry or some other very high paying job, and your cost of living is 1/3 potentially, or maybe 1/4, it's an amazing difference. So I still think that there's enormous upside because of the quality of jobs moving into that area, but I would be surprised if it continues a 43% pace. That's just a huge number over time. Right.
Hey, Austin, I muted you, so you're on mute. I'm sorry.
Can you hear me now?
Hey, we can hear you now.
Perfect. Awesome. So Texas overall, and this isn't focusing on a specific market, but or an individual area, but we are at an unprecedented low months of inventory at 1.2 months. Obviously, we just covered Austin, which is lower than that. But the Texas average days on market fell to a record-breaking 34 days. So 34 days on market is the average over Texas. And you saw how a few of the markets in Texas are even lower than that. As far as the Texas median home price rose for the 5th consecutive month, accelerating 21.6% year over year to a record-breaking $292,000 in May. And you can see that some of the markets are way above that in Texas, but again, this is just Texas overall. And the last point there is Fannie Mae and Freddie Mac and the Centers for Disease Control and Prevention federal eviction moratorium was recently extended through July 31st. So this is important for people who do have conventional loans to take note of this. And I do get a lot of questions, and I get a lot of people that may be apprehensive to invest in real estate due to the eviction moratorium. And one thing I want to point out is that there are other options. If that is a break it, you don't want to invest in real estate just because of that, because you're worried that you won't be able to evict somebody if you get them in. We do have other loan options that do not fall under the guidelines that are conventional loans, which are these. So our non-QM options, you would be able to. It doesn't fall under these rules. And during COVID, one thing that I just want to point out is that many people said, well, even I had a non-conventional loan and I still couldn't evict. And the reason for that is because the courthouses weren't open. So it wasn't because of the laws or the moratorium that was put in place. It was because the courthouse wasn't open. And now that we're more open, if you did go a non-QM route, you're not stuck under the provisions that have been put in place for the eviction moratorium. And as for the rest of the country, is seeing a slight decline, the Texas real estate is continuing to boom. So I think that is the takeaway of this presentation is that even though things are starting to steady out and decline in the rest of the country, Texas real estate is continually just growing. And one thing I always tell everybody is don't try to time the market. At the end of the day, the best time to invest in real estate is right now. People I talk with that was on the fence investing, 6 months ago, a year ago, are kicking themselves now because they didn't get in at that time. If you look another 6 months in the future, you're going to be wishing that you jumped into it at this time. And also, if you're new to investing, the biggest piece of advice that I could give is just jumping into it and getting experience. Maybe you want to look at something with a smaller repair budget, but definitely just going through the process and getting the experience is going to be worth more than anything that you can read or learn. So I would definitely advise doing that. And I believe on the next slide we're going to be covering the
Affordability index.
Affordability index. That's right. Perfect.
I will make one other quick comment to echo what Austin was just saying about gaining experience. And if you're nervous about, there will eventually be a time whenever the market comes down a little bit, right, in real estate. That's happened a few times in the past. Not so much in Texas, other than the 80s. It's been a while since there's been a big drop. Like even in the financial crisis, some markets went down slightly, not significantly. But the key thing to keep in mind is that that eventually does come back up. And if you're not planning on selling at that immediate time, if you're doing a buy and hold investment, it's just a paper loss at the moment, right? It's not really a true loss. You're not taking a loss at that time. And the other thing to his point is, people pay enormous sums of money for a college education that really depends on someone else deeming that education to be worth paying you more. If you happen to lose a little bit of money on your first deal in real estate, that the education that you earn is completely in your control. And whenever you learn those lessons, you control your ability to make more money flipping houses or buying rentals in the future. Instead of paying $70,000 or $100,000 for a college education, and, if you said you're going to lose $100,000 on a house, you'd be like, oh, that's preposterous, which it is, and we don't see that happen really ever. But to get into it, maybe lose a little bit on a deal because you might make a mistake. You may not make 40K like you thought. You made 30 because you made some mistakes. It's a very small price to pay, and every time you do it, you continually get better and better and become a more profitable investor. So I think that's a great point that Austin made. Here's the affordability index, which is always a powerful chart, and it's one of the reasons that we believe that even if the rest of the country is slowing down, as it is, not slowing down where prices are going down, but the appreciation rate isn't as high. The reason that Texas is not seeing as much of that yet is really in large part this chart. So if you look at New York, for example, people have to spend 84.72% of their income on their mortgage payment, including principal, interest, taxes, and homeowners association dues. Enormous sum. So you're looking at New York, Los Angeles, Miami, biggest cities in the country, San Francisco, right? Those are all well above what you see in Dallas and Houston, right? Those are two of the top 6, 7 cities in the country based on size, economic opportunity. Austin, right there, still relatively affordable because the ability to earn money there in Austin is great because the high-tech jobs and everything, higher household income, but also more expensive homes. And then you look at Irving, still, that's part of that DFW area, still very affordable. San Antonio, look at that, 31.62. That's a good ratio for future rent rates there. You got Laredo, El Paso, Corpus Christi, some of the tertiary markets that are also attractive markets to get into from a buy and hold investment perspective, which we are working on expanding our footprint outside of those major metros right now, and I think we're going to be coming out with some great news in the not too distant future on that. But at the end of the day, I think that is what's really going to continue to drive, not the 43% necessarily in Austin going forward, but whenever you look at that Austin level of income, 71, is not nearly what it is in San Francisco at 112. But I think you're going to see that shift as some of these companies move, and that number could continue to go up. And there's just an enormous opportunity for growth in the home price before it becomes as problematic as those other markets. And then in addition to that, if you look at the other factors of affordability in Texas versus some of those places on the coast, it's also more affordable in other areas, not just home prices, from food costs to other things. So it's really a reason that we anticipate continued growth. It's an exciting time as we look to the future in the state of Texas for sure.
Awesome, thanks guys. So we do have a couple questions lined up. Anyone that has to hop off early, make sure that you have our social media linked up, you're liked, you're subscribed, you're hanging out with us, because we share a lot of really great articles, some of which we covered today. We also share resources, upcoming networking events. We're going to a few this month, and as we've mentioned, we've been to quite a few already. So be sure to like, subscribe, and stay connected with us. I am going to go ahead and jump in. If you haven't asked your question yet, please do so in the question box. The first question that we got today, Austin, I'm just going to let you know, someone is asking for a hard money loan. They're a Lifestyles member. I gave them your email, so we'll get you set up today. Cheryl, thanks for reaching out. And if anybody wants to reach out and talk to one of our loan officers, you can call this number here. You can email us at info@catalystfdg.com as well, and then we'll have someone call you back today. Without further ado, I'll go ahead and actually kind of skip around in questions, because what you just left off on goes into one of the questions that we received a few slides prior, which was, how long do you expect the economic boom to last in Texas?
Sorry, I was muted. I think until the affordability index becomes more problematic, because home prices continue to appreciate in California and New York well above where our affordability index is. So could there be some short-term even decreases that are nominal? I do believe that that's a possibility. You never know what other economic factors may come into play. But that affordability index, if you have flexibility to move around the country and you see strong economies, cosmopolitan cities with attractive things to do, entertainment, restaurants, good job markets, and significantly more affordable, I think we're going to continue to see that. Also, I didn't even mention, no state income tax versus what a lot of the other states have. So I think it's very hard to have a crystal ball, but I do not see a time in my own personal viewpoint where prices drop significantly for the foreseeable future. Something would have to change relatively significantly to make me feel like that's probable.
Yeah, actually on one of our previous webinars, I think we covered it twice in the past, maybe April and May, we found a report that showed Texas has been one of the top 2 states every year for the last 5 years with the most new residents moving from outside of the state coming over here. So I think that's a really strong indicator for continued growth as well.
Yes.
So our next question is, when do you think mortgage rates will go back to pre-COVID norms? Sorry, that was a tongue twister for me today. Would you like me to read it again?
Austin, you may be on mute.
Oh, whoops. Is Austin speaking? Huh. Can't hear you, Austin.
I will go ahead and take this one. Austin may be having a technical difficulty there. I'm sure he had a great answer, and I will not do as well, but I'll give it a shot. I think the question was on interest rates, correct?
Yes, the question is, let's see. I have all these little screens to read them, sorry. When do you think rates will go back to pre-COVID norms?
Well, I'm not sure exactly what the pre-COVID norms were, if you're going to speak specifically about that. But if you're asking if interest rates are going to increase, I think the consensus is yes. That's from Fannie, that's from Freddie, that's from other prognosticators. So I do believe that interest rates are going to go up. We happen to have, the interest rates in general are one thing. Non-owner occupied rates are an entirely different thing because of some fundamental changes that the government made to the amount of properties or loans that could be delivered to Fannie Freddie. So that has, in large part, it's improving, right? So we have seen improvement in non-owner occupied rates, but that spread is always going to be there over owner occupied rates. And we did see the projection that it will be like 3.6 and 3.8 on owner occupied. There's often a 1% increase over that. So it could be 4.6, 4.8. And that may be 1.2 points higher than what we are at today, possibly at that time frame. Now, that's still historically incredibly low, and you can still definitely cash flow, especially with the rent increases that we project happening. But to Austin's point earlier, wouldn't you rather have even more cash flow by getting a lower rate today? And that's why we believe time is of the essence, and why we and many others are trying to buy as many properties as we can, because home prices should continue to increase. If rates also increase, you're probably not going to get a better cash flow than you can get today.
Yeah, and can you hear me okay now? Perfect. I just wanted to say one more thing. I talked to a lot of people about interest rates, and there's like a recency, I guess, bias with interest rates, because previously, the last 6 months to a year, interest rates have been incredibly low. But if you go back just 2 years, interest rates for investment properties, we were closing loans all day at between 5 to even the high 6% range. So just being in the range that we're at right now, and as an investor, you don't want to get caught up in, a quarter or half of a percent whenever you're still in the 4% range and 3% range right now. So don't let that be a determining factor to jump into it, because they are historically low they're still low, and you can't really get much closer to zero, especially whenever you're looking at, the historic rates over the past 10, 15 years.
I remember we were at a networking event, Austin and I, not too long ago, and people were like shocked that we were at 5.5% on non-owner occupied. They're like 5.5%, like they were really shocked by that, right? Not too long ago. So a few years, don't get me wrong, but and we're now refinancing those people, because rates are so much lower than they were just a few years back. So it's definitely a very attractive rate time. Any other questions, Destiny?
Yeah, sorry, we have 3 more. I've got Windows popping up. I apologize. My teams, they're messaging each other. It's like AIM if you guys don't have Teams, so there's just little bubbles pop up on the side of my screen. So we have 1, 2, 3 more questions. We'll go ahead and jump right into these. So this question, do you think they will continue to extend the eviction moratorium in Texas? And if so, for how long?
We don't know what's going to happen. There's a new COVID variant. I don't know what exactly is going to happen with that. With that said, the federal Fannie Freddie moratorium is only going through July 31st. As far as I know, we've not received any new direction on that. I do know that there are evictions taking place in the courthouses at the moment in the markets in which we work, and that we have seen people, ourselves included, be able to handle some evictions when necessary. But it is a time whenever some of that is somewhat undetermined. Although one other exciting thing that we've seen for people that if they do extend those moratoriums, there is something called Texas rent relief. If anybody on the phone has had a person who has not been able to make payments, one of their tenants, that is an exciting opportunity. The tenant does still need to be in the property, but if you've kept them in the property, you can get rent relief for payments that have been missed. So that's another thing to keep in mind. And I do believe if there are moratoriums that are put in place, there will be programs that can help you, or I would hope there would be. There's no guarantee, but at the moment there are programs that can really help if you are trying to keep the person in the place.
Thank you. Great answer. So this question is, are days on market decreasing for all segments in the market? Houston/Austin ? So I think they're asking, is it all over? Is it every market that we're seeing these decreases for days on market? And if I didn't understand your question right, let me know.
Austin, I don't know if you have any thoughts on that.
So as far as going back to the slide, whenever we were talking about the building permits and builder sentiment, the days on market right now are very low. However, prices are very high and building permits have slowed down. So that would lead me to believe that the days on market, my personal opinion is that the days on market are going to remain the same, or it's going to be steady for the next, at least the foreseeable future, in my opinion. I'm not sure, Wade, what you think.
Yeah, I don't think there's any indication that's going to be a problem for flippers in the near future, but you don't have to have historically low days on market in order to be a successful flipper, right? So yeah. Austin's point, I don't think it's always going to be this fast. It's kind of unprecedented and unrealistic to think it'll be this low forever, but I think you can still be a very highly profitable flipper, because one of the things you have to think about always is speed is a huge part of the game in being a profitable flipper, because if you're borrowing with hard money, the interest rates are a little higher and you want to get in and out of that deal as quickly as possible, right? So the amount of time that the property is on the market is a contributing factor, but it doesn't have to be, incredibly low for you to make good money.
Thanks, guys. And we have, Jiminy Crickets, a few more came in. Let's see. Do you originate loans outside of Texas, specifically Tennessee, Arkansas, and Atlanta?
So we are definitely on the conforming side, and on our anything long term, we can do in all those markets, yes. Our hard money, we are working on expanding products. Atlanta is a market that we are going into along with Phoenix in the not too distant future. The other markets, I believe, Arkansas, we are working on a program to be able to get a more national reach on hard money. That may be a few months out. So stay in touch with us. But in the immediate term, we definitely have alternatives for any type of long-term hold. That would include, our conforming products. That would include our non-QM products, blanket loans, the VRBO, Airbnb type products. All of that we can definitely help you with. Destiny?
So sorry. Yep. I was responding to a question that was pretty specific, so I'm directing them to a loan officer. And again, if you guys have really specific questions about deals that you're looking at, we're happy to discuss them with you one-on-one. I think that is it for our questions that would be helpful to everyone on the webinar. So guys, thanks again so much for coming on, and thank you, Austin and Wade, for giving us all this amazing information today.
Thanks, everybody. Happy investing. Talk to you soon.
Happy investing. Let's say that every time. That's a good one. All right. Bye, guys. Thank you.